In the early 2000s, the world economy looked calm and safe. Interest rates were low, markets were stable, and volatility was almost invisible. Investors slowly began to believe that risk had disappeared. When everything feels safe, people naturally take more risk, and that's exactly what happened. Banks and investors started pouring money into complex products that promised higher returns without fully understanding the hidden dangers. One of those products was the collateralized debt obligation, or CDO. Imagine bundling together 100 or even 125 home loans into one big package and selling pieces of it to investors. On paper, this looked safe because if one or two homeowners defaulted, the rest would still pay. But here's the catch. These loans were not truly independent. Risk managers had to estimate thousands of correlations, sometimes over 7,000 relationships, and small mistakes in these estimates could mean huge losses. To make things look even safer, banks divided CDOs into layers called tranches. The equity tranche absorbed the first losses. The mezzanine tranche took medium risk, and the senior tranche was marketed as almost risk-free. Investors believed the senior layer was protected. For example, if losses were just 5%, only the equity investors would suffer. So pension funds and large institutions happily bought the senior pieces, thinking their money was secure. But this safety depended on one big assumption: low correlation. The models assumed that mortgage defaults would happen randomly and separately. Maybe one family defaults in Texas, another in Florida, unrelated events. But when the housing market started falling in 2007, something dangerous happened. Defaults didn't occur one by one. They happened together. Correlation jumped dramatically. Instead of small scattered losses, the system faced mass defaults at the same time. Suddenly, losses weren't 5%, they were 20% or 30%, and even the so-called safe senior tranches were wiped out. At the same time, banks had another tool called credit default swaps, or CDS, which worked like insurance on bonds. The market exploded from about $8 trillion to nearly $60 trillion. But this insurance came with heavy leverage. Many firms were borrowing 10 to 20 times their capital. That meant even a tiny 5% loss could erase all their money. Once losses began, firms were forced to sell assets quickly, prices dropped further, and panic spread everywhere. What started as a small problem in subprime mortgages soon became a global disaster. Hedge funds collapsed, banks failed, bond ratings were downgraded, and stock markets crashed. Assets that were supposed to diversify risk started moving in the same direction, downward. Correlation across markets went close to 1, meaning everything fell together. Diversification stopped working, and the entire financial system felt connected like falling dominoes. In the end, the big lesson was clear. Risk isn't just about how much you can lose on one asset. It's about how many things can fail at the same time. Correlation, which seemed harmless in good times, became extremely dangerous in bad times. That's why regulators later introduced stricter rules like higher capital requirements and Basel III standards, forcing banks to prepare for extreme scenarios. Because in finance, the real danger isn't when one thing breaks. The real danger is when everything breaks together.